Hey everybody, I'm doing my favorite video. I've done variations of this video in the past. It's called Connecting the Financial Statements, but I'm going to go through it live so you can ask questions. And so I'm going to show you all accounting transactions for the income statement, balance sheet, and statement of cash flows. And I'll go through each year of a company. So 2020 will be the first year we'll start a private company. And then 2021, we'll grow and scale the company. I'll show you all the transactions every single year. 2022, we'll take the company public. 2023, we'll acquire a company. We're back. It's Grief from yesterday. Hey, Grief. So that's the gist of it. And some of you might be familiar with this kind of thing I did. It's called Connecting the Financial Statements. And I really like these series of videos, mainly because I kind of came up with the concept on my own. And I kind of feel it's very straightforward. It's, at least I think it's the most straightforward way to convey accounting and finance, because accounting is different than finance, because accounting is just really numbers and rules, but finance is trying to look at the business to see if you want to invest in it or not. And a lot of us either have our own business or want to invest in other businesses, or just want to understand it better. Thanks, Mark. So we started a company. We'll start a company in 2020 called Slippers Beyond Retail. And no one has told me, I asked, does anybody know the significance of the company name, Slippers Beyond Retail? There's some real connection to me, but no one's ever figured it out. Does anybody know? I guess that's irrelevant, but if you know why I picked that name, let me know. So we're going to start a slipper company, and we're going to design slippers and sell them to retail stores. So we'll manufacture this product. So when you start a business, the very first thing you do, I'm sure everyone knows, what's the first thing you have to do to get the business moving? That first transaction. I'm talking about in terms of accounting. What's the first accounting thing you need to do to do anything? You have to, well, file an LLC. That's a good one. Technically, you don't have to. It's a good idea to file an LLC and incorporate. But I do like that answer. I'm talking about for accounting purposes. You have to fund it. You need cash. So the first transaction, I just kind of made these notes for me so I don't forget. So the first transaction is we're going to add $5 million to the business, and we'll just pretend we got it from our bank account. I know that's a lot of money, but let's just. So what happens? What do you do to the financial statements when you add $5 million? Well, the first thing is cash goes up $5 million, right? And then we know for the balance sheet, it has to balance, right? So my balance sheet looks a little odd, but I need just this visual so people can see everything. So the green part is assets, the red part is liabilities, and the pink part is equity. It's going to look like this on each year. So assets, which is green, minus liabilities equals equity. That has to balance. That's why they call the balance sheet. Right now, it's not reconciled. So where does this $5 million go? Well, it's not a liability. We don't owe anybody anything. It's owner's equity. It's going to be our equity we put into the business. So it's equity is like the value of the company according to the balance sheet. So now it's balanced, it's reconciled. Assets 5 million minus 0 equals 5 million. Okay, so we did the first transaction. But when you start a business, you actually don't need to create your own entity. Like, you don't need an LLC, you don't need a corporation. Of course, if you don't incorporate, like if you don't create like some type of entity like that, you could get sued and lose all your money. So it's probably a good idea to create an LLC. But a lot of people, they just start doing things that, like, if say you're kind of a landscaper, so you charge people $100 a week and you mow their lawn and you cut their weeds and things like that, and you just get that money from them, and then you file taxes at the end of the year. but please comment. It helps me. Don't think you're interrupting me. That's why I'm doing it live, because I have done this video. I did record this video, so you can watch it without any interruptions and without me stuttering. But doing it live, I think, is good. Okay, so we have cash for our business, and if you want to, if in your mind, if you want to think you got the 5 million from maybe a relative or a friend, I mean, there's a lot of ways to get the money, but I'm just keeping it simple, because if we get from investors, then I have to kind of like do different things and it gets confusing. I'm trying to keep it real simplified, at least the first year. It's going to get a little more complicated as time goes on. So we have to start operating the business, doing something, right? So I have these little notes here on the side, because it gives me like a check to make sure I'm doing it right. Because once you go through all these transactions, it gets kind of, there's a lot of room for me to make a silly mistake. Like, for instance, if I put 500,000 instead of 5 million, then once I get to the end of the year, I can't figure out where my error was. So anyways, so the first thing we're going to do is we're going to buy inventory, because what our business does is we make slippers. We make them nice and we sell them. So there's a company called Slippy. That's the name of the company. And they just sell generic slippers, like basic slippers, nothing really added to it. And that's what we want. We just want something, real plain, so we can add cool designs, things like that, and then sell at a markup. So we contact Slippy and we say, can you make us $1 million of product? And they say, sure. So we wire them $1 million, and they mail us $1 million of generic slippers. So what is the accounting transaction? Please let me know in the comments if you know the transaction, because this is kind of interactive. But yeah, cash goes down because we're going to wire them $1 million. So we have to take $1 million out of our bank account, and our inventory has increased $1 million. So the balance sheet still balances. So you always want to make sure it's reconciled, because like I said before, and this happens all the time. Like, you go, you're typing it in, and I put 100,000 instead of $1 million, and I'm off at 900,000, but it's all reconciled. We take the slippers from the company we bought for cheaper, then we put our twist on it and we sell it to retailers mocked up. That's exactly what we do. So I have this cool way to make the slippers look really nice, and it doesn't really cost me that much money. I have these simple tools where I kind of like just put some little design on it, like whatever you want to think about it. And now these generic slippers are kind of cool looking, so I can sell them for a higher price. And our only customer is Walmart. We have a great relationship with the buyer at Walmart, so we show them our product. They like it. They say, we'll take your entire inventory, the entire million. So what happens? Well, inventory goes down $1 million, right? And where does that $1 million go? Because it's the balance sheet is kind of like where we store information. We store numbers. We store dollars. But once we sell something, once we start to bring in revenue, then we can now move that money onto the income statement, because the income statement shows us how our business is doing, our profit and loss statement, so they call it. So where does this $1 million go that I'm taking off an inventory? Does anybody know? We took slippers. Hey, single cell, thanks a lot. So somebody throw it out to me. Where does that $1 million go now? Anybody, any ideas? Well, it's going to go to cost of revenue. It's going to go to cost of revenue, because that's how much it costs us to buy that inventory. It cost us $1 million, right? So the cost of the revenue is $1 million. But obviously, we're going to sell it for more than $1 million, because we're a business. COGS, exactly. We're a business, and we want to make money. We want to be profitable. That's the whole point of a business. So what we do is we double. That's our standard thing, and it seems to work. So we obviously have to negotiate with Walmart before before we sell the inventory. So we tell the buyer, you see these nice design slippers, we have different colors. We'll send you all 10,000 pairs, and it's $2 million. And they're like, fine. So we remove our entire inventory onto COGS, or cost of revenue, same thing. And then we receive $2 million from Walmart, because they're going to pay us for the product. So what do I do with the $2 million? How do I record it? Swibex, what do you think? So we know anytime there's a accounting transaction, a financial transaction, anytime, it has to go to 2 places at a minimum. It might go to more than 2 places, but it has to hit 2 places. And those 2 places have to be either both on the balance sheet, both on the income statement, or one on the balance sheet, one on the income statement. Or there might be 2 transactions on the balance sheet, 1 transaction on the income statement, but there has to be at least 2 transactions. Your revenue goes to $2 million because you sold to Walmart $2 million, and you debit cash. You don't credit cash, which just sounds weird, but you debit cash when it increases. So on this 4th transaction, you receive $2 million of cash from Walmart, and you ship them the slippers. So that's revenue. You got to book the revenue, and you get $2 million of cash in the door. Great. We want cash. Okay. Yeah, Swibex gets it. But anybody else, feel free to ask questions. Now, we didn't do it all by ourselves. We had 10 employees, and my process is I show the employees like how to design the slippers, and then by one they do what I tell them to make them look nice. And I know if this was a real company, we would have to buy like supplies. We'd probably have to buy like, if I did design it, we might have to buy like cool logos or different like threads or, that would be, but I don't want to get too like where it's confusing and people can't really follow along. So I'm just gonna assume we did it all by hand, as if that's even possible. But I showed these 10 guys or 10 girls how to make these generic slippers really cool looking. So 10 employees, they get $50K each for the year. So $500,000 in payroll. So does anybody know where the $500,000 goes? We know it has to go to two places. And it's going to be one place on the income statement, one place on a balance sheet. So where does the $500,000 go on the income statement? And anybody can guess. I mean, there's only three places that you can see. Yacero, I know what you mean by SG&A. But SG&A would usually be below gross profit. Since these employees are directly tied to making the product, their salary is going to go into cost of revenue. Because you have some people, if you look at an income statement, you might see like a lot of different line items. You might see like cost of revenue, R&D, marketing, income taxes. But actually, salary can be in multiple buckets. So their salary is going to be in cost of revenue, or COGS, because they're $500,000, because they're directly linked to making the product. My salary as the owner wouldn't go into cost of revenue. But I'm not taking a salary, so we don't have to worry about that. And then the balance sheet has to balance. It's off by $1 million. So we have to minus $500,000 from the cash. And now we're not balanced. So obviously I made a mistake. Did anybody know what I did wrong? This is why I have these notes. Let's see. So, okay. So 5 million of cash minus 1 million of cash plus 2 million of cash. 5 minus 2, 7, 6, so 5.5. Revenue is 2 million. I'm stumped. Can anybody tell me? Well, I'm not stumped. Well, Swybeck's kind of, he gets it, I guess. Yeah, exactly. So Swybeck's gets it. So it's not actually unbalanced, even though assets do not equal liabilities plus equity, because at the end of every accounting year, which we're going to do, and it makes a lot of sense when I do it, we move anything from net income into retained earnings. So once we move that $500,000 into retained earnings, it will balance. So these numbers match, so it does balance. And if that sounds confusing, don't worry, because in 10 minutes when we finish 2020, it'll make a lot of sense. So the sixth step, Swybeck's, has my videos helped you, or you just understood financials before watching my videos? I have a feeling you understood it before watching my videos, but that's good that you're on top of everything. How old are you, Swybeck's? Just out of curiosity. Okay, so now the next step is we pay taxes. Okay. Mike, what's up? 36. Nice job, Swybeck's. So we pay taxes. So I'm just going to have a standard amount of taxes we pay, just to kind of keep things easy. And it's never like this easy. But if I make it complicated, which we will maybe do a little later in 23, 24, we're just going to do a standard 20% taxes on operating profit. So whatever the operating profit is, in this case, it's $500,000, then we pay 20% on taxes. So income statement goes up $100,000, cash goes down $100,000 because we write a check to the IRS, send them $100,000. And most companies do pay quarterly taxes. Some companies pay, if you're a really big company, you might pay monthly taxes, but a lot of companies pay quarterly taxes. They send it to the IRS. Like at the end of each accounting year, your CPA, your accountant, will say, "What do you expect to earn next year? Do you expect to earn the same amount as you did in 2023?" And if you said, "Well, actually, I think I'm going to earn a little more, so I think I'll earn about $200,000 next year profit," so your accountant will go, "Okay, $200,000." And your tax rate is 27%. So then they send you these 4 slips of paper that says that are addressed to the IRS for $13,500. So you have to write a check for $13,500. You put one of the slips of paper with the check. You put an envelope. Every quarter, you send $13,500 to the IRS. That's how most companies do it. Most companies of normal size. And then, of course, if you're not as profitable, like you told your accountant you'd probably make $200,000 for 2024. So your accountant estimated you would have to pay $54,000 in taxes for 2024. So each quarter you would send $13,500 to the IRS. But say the year is over and you actually made $180,000 in taxes. What happens? You just get a tax refund. So maybe the IRS would send you a check for like $5,100. I don't know. Whatever you overpaid. And if you underpaid, then you would have to pay the IRS more money. But this company, we're doing a whole year. So this is the entire year of 2020 we're doing accounting for. So now we're done. We're done with our accounting transactions. But we still have to populate our statement of cash flows. And we have to zero out our income statement and balance sheet. Because at the end of every accounting year or accounting period, you have to zero out your income statement. And your balance sheet, then you have to adjust it for net income. I'll just show you how to do that. Okay, so we're done for the year. We look at our balance sheet. We have 5.4 million of cash. We have 5 million of equity. We sold 2 million of product. Our cost of revenue was 1.5 million. So our gross profit was 500,000. So if your wife or husband said, "Oh, so what's your net profit margin?" I would say, "Okay, my net profit margin, 400,000 over 2 million, 20% net profit margin. Oh, that's pretty good for first year, 20%. Maybe next year it'll be higher." And then if your friend said, "What's your gross profit margin?" You go, "Okay, let me see. Gross profit 500,000, 500,000 over 2 million. Gross profit margin 25%." He said, "Oh, that's okay. Could be a little higher, but 25% is decent." So let's populate our statement of cash flows. So to do that, we first have to calculate operating cash flow. So the way you start operating cash flow, you put your net income in. That's the very start. And then you have to adjust for the non-cash items on the income statement. Well, there were no non-cash items. There will be. Next year there will be. But this year there's no non-cash items. There's no changes in working capital. So our net income is our cash flow from operations. They're equal. So we did that step. Now we look at the next section, cash flow from investing. If anybody has questions, if it's not clear, let me know. Nothing in cash flow from investing. And then the last section is cash flow from financing. That's if you took on debt or equity, paid debt or equity, paid a dividend. So we did add 5 million. From our initial deposit. That goes into cash flow from financing. The $5 million we deposited into the business. Now let's reconcile our cash. So what was our cash at the very first day of the year on 1/1/2020? It was zero. I'm saying before we funded the business. There was no cash in the business, right? And what's our cash balance on 12/31/2020? Well, it's 5.4 million. Okay, nobody caught this. You said it's hard to focus, but net income, I don't know why I put cash. Net income is 400,000. So net income is 400,000. So our operating cash flows are 400,000 because our net income, it's from the income statement. So that was a good check to reconcile cash. So we want to make sure our cash increased $5.4 million for the year because we had zero in cash to start the year. Now we have 5.4 million. And then that should be the sum of operating cash flow, investing cash flow, and financing cash flow, 5.4 million. And it is. And then free cash flow, which I know we talk about a lot, is operating cash flow minus CapEx. In this case, it's just it's $400,000 because there's no CapEx. So we had $400,000 of free cash flow. And this is going to be the only year where our free cash flow equals our net income. In future years, it's not going to equal. You'll see why. So we finished all transactions for 2020. For 2020, there's just one transaction remaining. We have to move net income to retained earnings. Because remember, retained earnings is a sum of all your prior net incomes since you started as a business. And then we have to prepare the financial statements for 2021. So in 2021, we're going to have zero revenue to start the year, and zero cost of revenue, and zero in deposits. So this is going to be our balance sheet on day one of 2021. 5.4 million, 5.4 million. Okay, so let's start 2021. So before the year starts, this is what our financial statements look like on the very first day of 2021. We have cash of 5.4 million. So we're gonna come on. So we're gonna put that on our cash reconciliation, 5.4 million. And then at the end of the year, we'll know our cash, so we can do the reconciliation. So that's the first step. Okay, so now we're going to operate our business. We're going to buy inventory from Slippy because we need more inventory. We have no inventory. We're going to buy 5 million of inventory. So we take 5 million out of our bank account. We wire it to Slippy, and he sends us $5 million of product. So in this transaction, everything was contained in the asset section. One asset went down 5 million, another asset went up 5 million. So our balance sheet balances. It's all good. Now, the next transaction, same thing. We have one customer, it's Walmart. They say the same thing as last year. We'll take all your inventory. It all sold out in 2020, so we'll take it all in 2021. And we said, and they ask, how much is it? And we say, same price. We will sell you $10 million worth of product. They said, sounds good to me. So, but Walmart says, well, instead of well, let's just do the first step. So we'll remove the 5 million of inventory and put it into cost of revenue. But Walmart this time says, can you extend us some credit? Because last year we paid you $10 million for the product you sold us. This year, can we give you 5 million cash and $5 million on credit? and you think, well, it's Walmart, they're gonna pay. There's not much of a risk of them not paying. So we're like, fine, you don't have to give us all cash. So we have to book the revenue because we sold $10 million to Walmart. It doesn't matter if they give us all cash, no cash, part cash. We have to book the revenue. That's the first thing. And then in their case, they're gonna give $5 million in cash, and then $5 million on credit. So cash goes up $5 million. Accounts receivables goes up $5 million. Accounts receivables is how much money they owe us, how much customers owe when they buy on credit. So you see it's $5 million here on the balance sheet because that's net income. Remember, at the end of the year, we're going to move everything from net income to retained earnings to balance the balance sheet. Okay, we're starting to grow, meaning Walmart wants to buy even more product, but we don't have enough to sell them. So I decided to invest in a slipper machine so we could make slippers faster instead of by hand. So I find this guy, Tony. His business is called Tony's Machines, and he has a slipper making machine for $1 million. So I, send him a check. He ships me the machine. So now I have $1 million asset. So I put $1 million on PP&E because it's a fixed asset. I put fixed assets. It's a different color, just to separate it so it makes sense. So current assets are in this bright green. Fixed assets are kind of in a dull green. So current assets are assets that can be converted to cash within 12 months. Non-current assets or fixed assets are assets that take more than 12 months to convert to cash. So we add $1 million to property, plant, and equipment, and then we have to minus $1 million from cash because we sent the money to Tony, and we estimate the useful life of the machine is 5 years, so we have to depreciate the asset over 5 years because we figured it'll be good for 5 years, and that's what we determined. And there's different accounting rules for how many years to depreciate a fixed asset for, but I don't want to go into too much detail on that. Let's just depreciate $200,000 per year for 5 years. So how do you record that? Does anybody know how you would record depreciation? Well, you have to reduce the asset on your balance sheet. So in my calculation, accumulated depreciation of this $200,000 is subtracted from the assets. It's not added. Like when we have cash, that increases your assets. But accumulated depreciation is a contra asset account, so it decreases the value of your assets. And then depreciation expense goes on the income statement. So if you were to look at your if you were to look at your balance sheet and you wanted to know what is the value of the fixed asset, section. It's just 1 million minus 200,000. So you would know the value of the asset according to the balance sheet at $800,000. And if this said $400,000, then you would know the value was $600,000. And once accumulated depreciation equals $1 million, then the asset is totally depreciated. The value is zero. Because if I just put $800,000 for property, plant, and equipment, and not the 1 million minus 200,000, then you wouldn't know, like, what was the original value of the asset? Was it $800,000? Was it $900,000? When you look at it now, you know the original value of the asset was 1 million, and we depreciated $200,000. Now, the next thing is we pay our employees. So we have 10 employees, $50,000 each. We give them $500,000 in pay for the year. So the payroll for those employees is cost of revenue. So we add $500,000 to cost of revenue, and we minus $500,000 from our cash account. And you can see the net income equals the reconciliation number. So we know we're balanced. Now the next step is calculating taxes. And ask any questions if anything's not clear. So our rule is we pay 20% taxes on our operating profit. So $860,000 of tax. So we first have to do the add our net income. So 3, 4, 4, 1, 2, 3. You could do formulas for all this stuff, which most companies would do, but I'm just kind of doing it like manually to show you the process. So to calculate operating cash flow, you start with your net income, then you add back the non-cash items on the income statement. What's the only non-cash item? Depreciation. So we add back $200,000 of depreciation. Because why do we add it back? It sounds kind of counterintuitive to add it back. I'll show you on the next section why you add it back. It'll make a little more sense when we do CapEx. And then we have to adjust for changes in working capital. So when there's an increase, we know accounts receivables went up $5 million during the accounting period, because at the end of 2020, there was no accounts receivables on our balance sheet. And now there's $5 million. So accounts receivables went up. What happens when accounts receivables goes up? Cash goes down. Because we didn't receive the cash. We sold them $5 million of product, but we didn't get any cash for it. They'll pay us in the future. So our operating cash flow is negative. Which looks odd, right? But at the end, we'll look at all the statements closer to understand them better. So now let's figure out our cash flow from investing. Okay, we did have a CapEx spend. When you buy property, plant, or equipment, you have to record that in your investing cash flows. Can anybody tell me how much CapEx we spend for 2021? I'll be right back in 1 minute, but somebody tell me how much money we spent in CapEx in 2021. Yeah, maybe. $1 million. Exactly. We spent $1 million on this machine in 2021. So we have to put the entire $1 million on the statement of cash flows because we have to track cash. That's the purpose of the statement of cash flows, to track cash. Income statement doesn't track cash, it's accounting. So $1 million of cash flow that went out the door, a negative $1 million. But every year on the income statement, we depreciate $200,000 for 5 years, right? But the reason it's a non-cash item is because we already took into account all the cash the first year. So next year we're going to have $200,000 depreciation. We have to add it back because we can't double count. Because if we didn't add it back, we would be double counting the depreciation. I mean this asset. We already took into account all the cash that occurred for this particular asset. Richie, exactly. Yusero, exactly. So I know a lot of people get confused with this, and I totally understand why they get confused with it, but hopefully you kind of see it now. Net income is your accounting profit. It's not cash. See, cash flow from operations is actual cash. But let's just finish this out so you can see. Cash flow from financing, nothing for 2021, right? There was no financing. Here. So now let's just reconcile our cash to make sure cash matches. We know cash on 1/1/2021 was 5.4 million because we input that at the very beginning of the year. Now the year is done. How much cash do we have? 3,040,000. So our cash actually went down from 5.4 million to 3 million. Our cash went down 2.36 million for the entire 2021. And we have to make sure that matches our change in cash. Because change in cash is operating, plus investing plus financing. That's your change in cash for the year. So if you look on a company's balance sheet, you can, and I talk about this in my videos, the beginning cash on your operating cash flow section, on your statement of cash flows, should match your balance sheet. And the ending cash should also match your balance sheet. So if you looked at this company's balance sheet on 12/31/2021, their ending cash would equal the cash here. And then if you looked at 2020 balance sheet, the ending cash would be the beginning cash for 2021. So if you were an investor, like you ask a friend to, can you invest in my company? I'm trying to grow it, and we're already selling millions of dollars to Walmart, but we need more capital to buy more inventory. And then your friend asks, well, how come, you had a net income, which is good, of 3.4 million, but how come you had negative cash flow? You lost 1.4 million of cash. And then you're like, oh, I don't really know. I know we did well. We sold a lot of product, but I don't know why we're losing cash. But you guys know why, right? We're losing cash because we extended so much credit to Walmart. We gave them $5 million of product, and they didn't pay us anything. It's accounts receivables. So it's sitting on the balance sheet as an asset, but we didn't get any cash for it. We're out $5 million of cash. We know, and we will get the money from Walmart. We're not too worried about that. But in terms of 2021, it doesn't look so great. We lost a 1.4 million of cash. But if you explain this to somebody and say, well, the reason we lost 1.4 million cash was because of this Walmart purchase, and there's not much of a concern Walmart won't pay. Walmart has a lot of money. They're not going to go out of business. So then your friend who may invest, feels a little more comfortable and may give you money. Okay. So the last step of the process is we have to take this 3.4 million, the net income, and move it to retained earnings. 3,440. And now our balance sheet balances, and we have to zero out everything on the income statement and zero out everything on the statement of cash flows. And at the end of 2021, this is our balance sheet. Assets minus liabilities equals equity. Looks good, right? Anybody have questions? Does anything not make sense? So this is what our financials will look like at the very first day of 2022. It'll look exactly like this. So now we're starting 2022, a new year. And we have to enter all the transactions. And we start the year. The only thing that has numbers to start it is the balance sheet. The income statement and statement of cash flows are all zero. So let's so we can reconcile our cash at the end of the year. Let's type in our cash balance. So our cash on day one of 2022 is $3,040,000. And then we'll start each transaction. We'll go through the list. I'm telling you, it's if I didn't if I didn't write these down, it's just so hard to keep track of all these different things, especially when you're live and like the camera's on you. It's a lot harder to focus. The income statement does not necessarily track cash. Exactly. Why are my numbers so small? When you say numbers, do you mean the screen is too small, or the numbers in your personal business are small? That's exactly what I try to convey. Is the income statement is your accounting profit or loss. It has nothing to do with cash, because we saw in 2021 we actually lost cash. Remember, we did this reconciliation, our cash went down. Even though we had 10 million of revenue, they did pay us 5 million, right? They paid us 5 million in cash and 5 million on credit. So that helps. They did pay us 5 million, but we still had a lot of expenses. We had to pay 5 million for product. We had to pay $500,000 for payroll. We had to spend we spent $1 million on this machine. We had taxes we had to pay. Okay, so we'll go through 2022. In the first year, this is what the first year looked like. And the income statement did equal cash in the first year. But that never happens with a regular business. Okay, so let's just go through each transaction. I guess that's why everybody keeps logging off, because I guess it's too boring. So let's go through the transactions one by one. Okay, so last year we extended credit to Walmart. So we sold 5 million on credit to them. So the first thing they do is they pay us $5 million, which is great. So they send us a check for 5 million because we bother them. We say, you still owe us money. And they say, okay, we'll pay. Sometimes you do have to borrow the companies to get money. So they send us a $5 million check. And then that means cash goes up 5 million, accounts receivables goes down 5 million. Now the next thing is we buy 10 million of product from Slippy. Remember, we buy those generic slippers and we make them nice so we could sell them. But we're a good customer for Slippy. So we ask, can you sell us on credit? Can you give us the slippers, but we don't pay you until maybe next year? And he feels comfortable because you're doing a lot of business with him. You've been paying in the past. So he says, fine, I'll sell you 10 million, but you don't have to pay me until next year, or whatever the terms you agree upon. So inventory goes up 10 million and accounts payable goes up 10 million. So now the balance sheet still balances. And you have 10 million of inventory that you mark up to 20 million. So you're going to sell that to Walmart. That 10 million of inventory, you're going to sell it to Walmart. So your inventory goes down 10 million. Your cost of revenue goes up 10 million. Because you sell everything in your inventory to them. So they owe you $20 million. So you have to record the revenue, 20 million, because it's revenue regardless of how they pay. Even if they never pay you, you have to record the revenue. Maybe in the future, you take a loss, but as of now, you have to record the revenue. And they are going to do the same thing as last year. Half of it in cash, half of it on credit. So 10 million of accounts receivables. And they pay you 10 million of cash. Am I going too fast? Because it seems like a lot of people aren't sticking around for a long time. Is it just too confusing, or is it kind of boring? I don't know. Now we have that asset. Remember the asset we bought, the machine, the slipper making machine? We paid $1 million, and we have to depreciate it each year for 5 years. So we depreciate $200,000 per year. So accumulated depreciation goes up to $400,000. And watch, when accumulated depreciation goes up, our total assets will go down. Watch, 28,840, 28,640. Because it's a contra asset account. A contra account brings down the balance of an associated account. So if it was a contra liability account, it would bring down the value of your liabilities. If it was a contra equity account, it would bring down the value of your equity. They have contra revenue accounts. It brings down your value of your revenue. Okay, so what was I doing? Okay, the depreciation. So we have to, we paid $1 million for the machine, so we're spreading it over 5 years, $200,000 a year for 5 years. Windsor, what's up? Yeah, this is like I was really looking forward to this live stream, and just nobody's sticking around. It's kind of depressing, but whatever. Maybe when they review, maybe people will view it in the future. Okay. Maybe this will be the exciting part. We're gonna IPO. We're gonna go public. And one thing you might not notice, but when we were a private company, it was called owner's equity. But when you become public, it doesn't say owner's equity. It says shareholders' equity or stockholders' equity, because there's not an individual owner or a group of people who own it. The stockholders own the company. So we're going to IPO. We issue 10 million shares into the open market. Usually when you IPO, you work with an investment bank like JP Morgan or Goldman Sachs, and they handle selling the shares into the market, and they take a big fee for doing that. We're not going to deal with that. I meant we're not going to do the fee. I'm just going to show you how much we put onto the balance sheet. So 10 million shares, $5 per share. That's what the public pays for each share. And the share could go up or down. It could go up to $100 a share. It doesn't matter. You're still going to get your 50 million, regardless of where the stock price goes. You're getting $5 per share. The company only gets the IPO price. They don't benefit from stock price going up in the future. Do companies typically guess on depreciation expense on machines? No, I mean, there's usually rules depending on the price of the machine and the type of asset. You depreciate certain assets over a certain amount of time. There's accounting rules. Like maybe real estate is depreciated over 15 years, and maybe a fixed asset like a piece of machinery under $100,000 is depreciated over 3 years or 5 years. There's usually accounting rules. But there's ways around the rules, because you can aggressively depreciate something, because the more you depreciate something, the higher your expenses are and the less you pay in taxes. I'll show you that in a little bit. It's a way to kind of like cook the books if you just add a lot of depreciation one year. That means you don't benefit from future years of depreciation. I'll show you on this one. Okay. So that's the IP. So we go public, 10 million shares. But how do you record that on your balance sheet? There's actually two things you have to record. First, you have to record the common stock value. And usually that's a lot smaller. If you ever look at the balance sheet, it's just something called common stock. And that has nothing to do with the value of the stock. That each share of stock is usually assigned a par value. It's an arbitrary value. It's usually like a penny or maybe a hundredth of a penny. It's just a mechanism to keep track of how many shares in the market. So this company assigns a penny as the par value for each share. So 1 penny times 10 million shares equals $100,000. So common stock, $100,000. And then there's something called additional paid in capital. So additional paid in capital is the rest of the money you raise from selling stock. So your cash proceeds were $50 million. $100,000 of that is common stock on the balance sheet. So 50 million minus 100,000 equals 49.9 million of additional paid in capital. So additional paid in capital, that's pretty much how much money you raised from selling stock. Does that make sense? So you IPO'd, you sold 10 million shares into the open market at 5 per share. That means you receive $50 million of cash for selling your business. And the way you record it on the balance sheet is you put $100,000 of common stock and 49.9 million of additional paid in capital. Let me just. So we're public. Congratulations, we did it. Now let's pay our employees. Did anybody notice? Let's see if anybody gets this, but I don't know if anybody's watching. Like, obviously the balance sheet is not balanced because it's off by $40 million. Assets don't equal liabilities plus equity. It's really off, right? Does anybody know what I need to do to balance the balance sheet? There's one transaction I didn't do. I don't know if anybody noticed. Because remember I said we went public. We IPO'd, right? And when you IPO, you get a lot of cash, right? So what did I do with the 50 million of cash? Where did I put it? Right, I have to put it in cash. So cash goes up because we get a lot of money. That's why we IPO'd, to get money so we can grow and buy other companies or whatever we want to do. So now it reconciles. See the 9.8 million? Okay, so let's pay employees. So now we have 15 employees, $50,000 per employee. So $750,000 of payroll. So that means our cost of revenue goes up to 750K. Our cash goes down 750K. And then we hired an HR person. So we're growing a little bit, so we need a little more help. The HR person receives $70,000 for their salary for the year. So cash goes down $70,000. But where do I record that $70,000 on the income statement? Does anybody know? Because you have to record all your revenue and expenses on your income statement. That's the purpose of the income statement. So where does that $70,000 go? Which section? Anybody? I know somebody knows. Exactly, SG&A, thank you. Because the HR person's salary is not directly tied to making the product. It's indirectly tied to making the product. So their salary goes here. Okay, good call, Yusero, thanks. Okay, now let's do taxes. So we always pay 20% of our operating profit. Oh, fuck. So 1.8 million of taxes. We write a check to the IRS for that dollar amount. Now our balance sheet still balances because reconciliation equals net income. Now let's look at our statement of cash flows. So first section is operating cash flow. It starts with net income. And now we have to add back all depreciation. So how much is our depreciation we have to add back? What number do I have to put into this cell? Yeah. Thank you. $200,000. Not $400,000, because each year. So this is where some people get confused. Why do we add $200,000? We're not getting $200,000. Because we already on the statement of cash flows last year, we recorded $1 million cash outflow already. So we can't double count it. And that's how you convert net income to cash, because $200,000 was not cash. So we have to take that 7.2 million and convert it to cash. Most of this stuff was cash, but not depreciation. Okay, so now we have to adjust for changes in working capital. So accounts receivables. So this takes kind of like, you got to keep track of this stuff. So at the end of 2021, we had 5 million of accounts receivables. That's how much were owed to us. Now we have $10 million of accounts receivables. So accounts receivables went up. So what happens when accounts receivables goes up? Can't read the spreadsheet. Well, the gray background on the income statement column is the worst offender. Okay. That's probably why people aren't. I wish I knew this. That's probably why no one's watching, because they can't even read a spreadsheet. What a waste of time. I could have been like, now it's going to take me forever to clean this up. So stupid. Shit. I wish. When I'm so stupid. That's the hell. What a waste of time. I try to make it. I changed the fonts so it would separate. It would. I could make things clearer to see, and it made it worse. Oh, such an idiot. Is that clear, or is it still like kind of like hard to see? Okay. What a bad idea. Okay. Okay, so let's finish completing the statement of cash flows. So accounts payable, can you see that? Is that visible? The 10 million for accounts payable? I've done this before, this video, and I had more people watching. I think in the spreadsheet, I try to change it. Okay. So accounts payable, when accounts payable goes up, cash goes up. When accounts payable goes down, cash goes down. Because when you buy on credit, like remember how we bought $10 million of product from Slippies? Well, we received all that inventory, right? Well, it's not there anymore because we sold it, but we received all that inventory, but we didn't pay for it. So you could think of accounts payable as a loan, because when you receive a loan from the bank, you're getting cash. But we didn't get cash. We got product without paying for it. So it's just as good as a loan. So that's why cash goes up. When accounts payable goes up, because we should have paid 10 million in cash, but we didn't. So that's why cash flow increases 10 million. When we do pay, because we obviously have to pay the $10 million to Slippies. Remember, right here, we bought 10 million of inventory on credit. So we're going to have to pay for that in the future. And when we do pay for it, it'll be a negative accounts payable. So look at operating cash flow. Look how high operating cash flow is. But we'll look at it once we finish going through all these checks and balances. Okay, so in the investing section, nothing in the investing section because we didn't buy machinery, we didn't acquire a company, so that stays at zero. It's probably, can you read this, the PP&E thing? Is that hard to read too? Well, the inventory was there, but we sold it. So it's in cost of revenue now, all that inventory, because we sold it all. There's nothing on the balance sheet. I mean, it is possible we buy inventory and we don't sell it, or we don't sell all of it, but we just happen to sell all of it because Walmart has a lot of money, buys a lot of product. So nothing in the investing section. So we'll keep at nothing. But let's do the financing section. Cash flow from financing. We received a lot of financing because we went public. And when you sell stock, you have to record that in cash flow from financing. Same thing if you buy back stock. If you buy back stock, it decreases your cash flow from financing. So we have to put $50 million for the common stock issued. I probably should have just kept everything. So this is hard to read right here, like the revenue and cost of revenue. I feel like I wasted all this time. Oh, so stupid. Okay. Okay. Maybe I'll do this again with better fonts. Okay. Fucking unbelievable. Okay, so where were we? I don't even remember. Okay. Are we still in 2022? Okay. So we had 50 million of cash flow from financing. Okay. Now let's reconcile our cash, because our cash on 1/1/2022 is 3,040,000. That's how much cash we had in the bank. And if you look at your balance sheet at the end of 2021, we had 3,040,000. I did this video two years ago. Do I look a lot different? I got a hair transplant, so I think I have more hair now. So let's reconcile our cash. Okay, so what's our cash as of today, 12/31/2022? Well, we have a lot of cash, 65.4 million. So let's put that in our cash. So our cash actually went up for 2022. For our fiscal 2022 year, our cash went up 62.4 million. And that matches our change in cash. And what's change in cash? It's operating plus investing plus financing. Sure, we did go public and got $50 million. But why did we get so much more cash than last year? Because last year, last year we had negative cash flow. And this year we have positive 12 million. Does anybody know what the big, obviously our net income was higher. Because last year we had 3 million of net income. This year we have 7 million of net income. But what was the big change in operating cash flow that boosted our cash? We had 12.4 million of cash that we generated in 2022. What was the big factor that led to that? Yeah, that did help. Walmart paid. That was probably the second biggest factor. But if you really notice, they did pay 5 million, but we ended up giving them 10 million on credit this year. So actually, Walmart made it worse as a whole, because they paid the 5 million from last year, but then they added 10 million this year. So they still have $5 million in the wrong direction for us. The big one was we bought on credit. That was a $10 million plus for us. We didn't have to pay $10 million. We will have to pay for it probably next year, but for this year, it's a cash inflow. It really helps us a lot. Because could you imagine doing business? Like you obviously have to say you buy say you buy furniture and then you resell it. Like you buy it for $1,000 and then you sell it for $1,500. You don't even do anything to the furniture. You just know where to get good deals. You know how to find people looking to buy. So you buy furniture for $1,000, you sell it for $1,500. So let's just do one. You buy one couch, $1,000, and you sell one couch, $1,500. I mean, you made a $500 profit, which is good, right? Which is cool. But imagine you didn't have to pay anything. It was free. The person you bought the couch from said, you don't have to pay me anything. You have to pay. You can pay me next year, but don't worry about it. Don't pay me. Then you have $1,500 of cash because you sell it and you get that $1,500. That's kind of like what happened here. We got all this inventory for free. So it's $10 million. So that really moves things around a lot. But you'll see next year we're going to have to pay for that inventory. So then it's going to make our cash flows look pretty weak next year. But for this year, it looks good. Looks like, wow, we generated $12 million of cash flow, $5 million more than our net income. Okay, so I guess we'll do the final year. So let's just we'll have to zero everything out. So we move the net income to retained earnings. That's what we do at the end of every single accounting period. So 7,184,123. So now you see it reconciles, and then we have to zero out everything because the year is over. I should fix this. Okay. Whatever. Let me fix the formatting on this. We bought 10 million inventory on credit, but it wasn't recorded under the inventory, even though it was recorded on inventory. But we sold it. We put it in inventory, then Walmart bought it, paid for it. So we had to move it off of inventory. I mean, it did start as inventory. Well, I'll show you how it works in this accounting period, the inventory. Maybe I'll do this again next week with better fonts. I don't know. Okay. So this is the end of 2022. We'll start 2023. The income statement for 2023 it looks exactly like the end of 2022. So the very first day of 2023 matches the last day of 2022. So we'll go through all our transactions. So let's record our cash on 1/1. It's 65.4 million. So that's the first transaction, 65.4 million. Now we received $10 million from Walmart from last year. Because remember, last year, well, we could even look at it because our accounts receivables is $10 million. So that's from Walmart because they bought $20 million. They gave us half in cash, half on credit. So we zero out accounts receivables. We add 10 million. So that particular transaction was all contained in the asset section. One asset went down 10 million, accounts receivables. One asset went up 10 million, cash. This is the year we acquire a company. And we also record an asset impairment. Now we're going to buy 10 million. And that means our cash goes down 10 million. So you see reconciliation is still 0. Now we need inventory. We have no inventory. So we pay $30 million to Slippy, all on credit. He's giving us a great deal. So he's going to give us 30 million of inventory. So you see inventory is going up. The asset went up and the liability went up. So that's how it's still reconciled. Now, this time Walmart doesn't want all our inventory. We tell them we can sell you $60 million of slippers. Because remember, we double the price. So 30 million of inventory, we would sell them to them for 60. But they say, we don't want all your inventory. we want half your inventory. So well, not half your inventory, but they say they could only afford to pay $40 million. So we sell them 20 million of inventory. We remove 20 million. And our cost of revenue, see, this is where the inventory went last year. Now it's on our, okay. So since we sold them 20 million of inventory, we charged them $40 million because everything is doubled. We always double. So they're going to ask for a deal. They say, can we just pay you 20 million in cash, 20 million on credit? We say, fine. So our cash goes up 20 million. Our accounts receivables goes up 20 million. But does anybody know why things aren't balanced? Reconciliation is 20 million. Net income is negative 20 million. These should match. If this was 0, then this has to be 0 also. But if there's a number in this in net income, it has to match the difference. Because at the end of the year, we transfer everything over to retain earnings. So does anybody know what I missed in this transaction? Because it was bought on credit. No, I mean, we're not charging interest. I just never recorded the revenue. Because they bought, they gave us $20 million of cash, 20 million on credit. So, but I have to record the revenue, the entire $40 million. But that was a good guess. You know, this is the kind of things you need to think about. That's the only way to understand this stuff is to just try to understand how it works in different scenarios. So yeah, so I need to record the revenue, even though we didn't receive half the money yet. Okay, so now we have 15 employees. We pay them $50,000 each for the year, $750,000. So that means our cost of revenue goes up $750,000. Cash goes down $750,000. Remember, we have somebody that works in HR. Well, we raised that salary. We pay them $90,000. So that's an expense, $90,000, and we minus $90,000 from cash. So we're still balanced because this equals this. And remember that machine we bought a couple of years ago? We paid $1 million. Well, that's not the machine. Remember we paid $1 million for that machine and we depreciate it over 5 years. We depreciated $200,000 in 2021, $200,000 in 2022, but it's 2023, right? So we should depreciate another $200,000. But we actually find out let me try to make this bigger. So that's that machine we bought. If we tried to sell the machine, we would get nothing for it. It's worthless. Then the reason it's worthless is because there's a newer model that works 5 times. It's 5 times more efficient and it's half the price. So we have to write down the value of the asset. We have to make it 0, because what's the value of the asset on the balance sheet? It's $600,000, because it was $1 million we paid for it originally. We paid $1 million originally, and we depreciated $400,000. We depreciated over 2 years. We would have depreciated another $200,000 years. It doesn't matter if you're selling it or not. The purpose of the balance sheet is to record the value of your assets appropriately. And if the machine is worth nothing, we have to record the value, because if you sold the business today, right, and the person who bought it would think you have a machine that's worth $600,000, but it will be worth nothing in the open market. The same thing as if you bought, let's say you bought a building. Say you bought a building for $1 million, right? And let's just say, and you did it and you built it because you were to manufacture things in the building. And let's just say there was a tornado and it pretty much ruined the building. You can't keep the $1 million on your balance sheet. You have to maybe it's worth $200,000, because you have to put now $500,000 into it to bring it up to where it was before. So the purpose of the balance sheet is to record things, record what they're worth. Same thing with liabilities. You have to record the liability of what you owe. If you don't owe as much or you owe more, you have to record it properly. Does that make sense? So we have to pass through an asset impairment of $600,000, which brings down your net income for the year. And then you have to remove the asset off your balance sheet. But the thing is, that machine, you can still use it for like 10 more years. You can use it, even doesn't matter. It's the same thing as if you had a car. If you had a 1990 Toyota Corolla, right? and the Kelly Blue Book value was $300, but you still use it every day, it doesn't mean you have to just throw away the car and junk it because it's worth $300. If it works for you, use it. I mean, no one's going to give you $20,000 for it, even though to you it's worth a lot, because it's just as good as a $20,000 car to you because it works. No, I mean, right. It is 5 times slower, but it works. We get the job done with the machine. Now, if we want to invest in the more expensive machine, we can. But like, you could think of it as if we made a lot more slippers, then we may need the better machine. But we're not working at 24/7 pace. We're open 8 hours a day during the week, and we get our work done. We can make all the slippers we need to sell. If, for instance, we got Target and another customer who ordered the same amount as Walmart did, then maybe we would need to buy that new machine. But wait, if someone buys it, you're saying if someone buys the machine from us, is that if we can sell the machine, if we sell the machine, we do have to report what we sold it for. Like if you had like I said, if you had your 1990 Toyota Corolla with a $300 Kelly Blue Book value, right? And then your friend had, say you're a landscaper. You drive around. We'll call it a Toyota truck just to make it. So you have a 1990 Toyota truck with 300,000 miles, right? And you're a landscaper. You and the one guy you employ, you two go to each location with your Toyota truck, your 30-year-old Toyota truck. You have your equipment in the back. You go to each location, and it works. The car works. You're handy, so if things go wrong, you know how to fix it, but it works. And your friend, who also is a landscaper, has a 2023 Toyota truck. And he paid $50,000 for it. Just because he spent a lot more money on the car doesn't mean he could get more work done. You both get from point A to point B. And there's no way anybody would buy your truck. Say your friend needed cash. Say he needed to sell the business. He had gambling debts or whatever. So he needed cash really bad. So he was able to find someone to buy his truck for $30,000. Like, that wouldn't happen for you. You can't sell your truck for probably maybe $100, maybe $500. I don't know. It's just what it is. Your truck is only worth $300, so you have to report it on your balance sheet as $300, even though it works just as well as a $50,000 truck. Well, yeah, we should get the new model. That's true, but that's a different story. I'm just trying to convey that we have to report our balance sheet appropriately for what the asset is worth. And like the same thing with the truck scenario, even if you have a $300 truck, it might do just as good for you as a $50,000 truck because it gets you from place to place. It doesn't look nice, but who cares? It does the job. And if you were able to sell the truck for $1,000, then yes, you do have to report the income. If we do sell the machine, makes sense. It's all about accurate reporting. And what was your name? As income, other income. But right now, we don't need it. We can use the old machine, and we know it's not as good as a new machine, but it gets the job done. If we were a bigger company, we might need that new machine. But if anybody works at companies, you know, a lot of companies usually have like old products. Like sometimes they just keep using the same crappy old printer or same crappy old computer. Like they don't want to spend the money, even if it saves them money. But we're kind of getting off on I'm just trying to explain how it works for accounting purposes. So anyways, so we have to record an asset impairment, and we have to decrease the value of the asset on the balance sheet. Now, let's calculate our taxes. So we actually, when you calculate taxes, you have to exclude the impairments. So you actually calculate the 20% on your operating profit. You don't get a tax deduction for an asset impairment. It's excluded. You do get a tax deduction for depreciation. So that's why some companies use aggressive depreciation tactics, so they pay lower taxes. But you don't for an asset impairment. They get stripped out of the tax calculation. So we calculate our taxes based off of operating profit. This is really interesting because I think I did a video, and the company had like pre-tax income, like in 2021. I remember somebody asked about this. Like in 2021, they had pre-tax income of like negative if the machine suddenly became worth 1.5 million. That's an interesting point. You generally you could impair an asset, but you can't really add it back. Which doesn't sound like it makes sense, but I think it's just to try to limit people from taking advantage of but you generally can't. I guess it's possible you buy something and then it goes down, then it goes back up. It's pretty unlikely. There's not many things. That's why like land is always carried on the balance sheet at its original cost. So if a company bought land in like 1970, they bought a plot of land in New York City for $1 million. That plot of land may be worth $70 million today, but according to the balance sheet, it's $1 million. Could we merge with a company that has made a loss? By doing it would decrease our tax, as we can add it. Yeah, you could. What if the machine? Okay, so I remember I was doing a video and a company had pre-tax income of like negative 1 million in 2021. And then they had pre-tax income of like positive 500,000 in 2022. And they paid like I forgot the exact numbers, but they had pre-tax income in 2021 of negative 1 million, and they paid $125,000 in taxes. And then in 2022, they had pre-tax income of 500,000, and they paid like 80,000 taxes. And the person was like, "How come they're paying taxes when they had a loss?" And it's because like goodwill impairment is a common one. If a company passes through like a big goodwill impairment, you can't get a tax advantage from that. You have to strip it out when calculating taxes. And it does make sense once you understand it well enough, but because you did initially pay $1 million for that machine, and you depreciated so you initially paid $1 million for the machine, right? And in 2021, you depreciated $200,000. So you saved in taxes because your net income went down $200,000. So you paid less taxes. And then in 2022, you depreciated $200,000 again. So your net income went down $200,000. So you saved in taxes. You paid less taxes. So these first 2 years saved you in taxes, but then you wrote down the value of the asset to zero. It was $600,000 going into 2023, and we reduced it to zero, and we got no tax benefit from it. So it doesn't seem fair, but you don't get a tax benefit because it's worthless. You didn't. The value is nothing. It would be a different story if you sold the asset at a loss. Then you could write down the taxes on that. Well, we're getting a little ahead of ourselves, and I would like to talk about how taxes and asset impairments, but trying to keep this somewhat high level so people don't click off and they continue watching, which is I'm not doing a good job of that. So anyways, so 3.8 million of taxes, which is 20% of the $19 million operating profit. Then we have to reduce our 3832. We have to reduce our cash by $3.8 million because that's how much we sent to the IRS. So our income statement is complete for 2023. Now we have to populate our statement of cash flows. So let's see. So we start off with net income of 14.7 million. And then the asset impairment, which decreased our net income, right? Because our net income is $600,000 lower because of this impairment. So we have to add it back here because that's a non-cash item. Oh yeah, well, we still have an acquisition to go, but okay. I'll be right back in 1 minute, but leave a comment. Give me some questions so I know people are watching. Okay, let's see if anybody's here. So is this helpful at all to anybody, or is this Barrett Gold? Nice. This is like, I feel like my worst live stream. I was so excited about this, and but whatever. I complain too much. Okay, so let's complete our statement of cash flows. This is what companies do, though. By the way, this is not. This is how they gather these financial statements in order to provide them to investors. So by understanding how they do it, it helps you kind of analyze it better to understand if it's a good investment or not. Okay, so inventory. We have to minus $10 million because remember in 2022, we ended 2022 with zero inventory on our balance sheet. And now at the end of 2023, we have 10 million of inventory. When inventory goes up, cash goes down. So when you buy inventory, your cash actually goes down. When you sell inventory, your cash goes up. That's why when you look at some companies' statement of cash flows, they have a really big negative because they bought a ton of inventory in like October. Let's just say you were looking, you were looking at it on a quarterly basis. So in the third quarter, let's just say you were looking at this company, and every year on the third quarter, every third quarter, it seemed, they had negative like 25 million of operating cash flow. And you surmise this is due to inventory. When you kind of looked at it, it's like, and it seemed like every fourth quarter their operating cash flow was like positive like 40 million. What can someone tell me what's likely the reason? Like, you did the research and you identified inventory was the main culprit. There were other things in the statement of cash flows. There was like taxes, there was stock-based compensation, there was depreciation, but it seemed like inventory really stuck out to you. Like it was a really large number in the third quarter. Like operating cash flow is a lot of things, because operating cash flow is net income, asset impairments, depreciation, taxes, increase or decrease in payables, receivables. So operating cash flow almost every third quarter was negative 20, like around negative 25, 30 million in the third quarter of every year. And in the fourth quarter of every year was positive. And you're like, and it was inventory. You identified inventory as the main culprit. But why, can someone tell me like what's probably the reason? And it's a really obvious reason once I say it. But what's probably the reason this company, and a lot of companies for that fact, have this type of issue where their inventory is always, their operating cash flow is always such a big negative in the third quarter, but the fourth quarter is such a big positive? Like, what do you think? And there's one main thing, is the main culprit of the reason that's the case. Exactly. Holidays. Because a lot of companies stock up before Christmas. And it's not a timing thing. I'm not, like what the Forgotten Era said. Sometimes companies do buy right before, like certain things move operating cash flow right before the quarter end, and the next quarter it reverses. But this is a common thread with a lot of companies. So if you see companies with a lot of revenue in the fourth quarter compared to any other quarter, or a lot of inventory spend, or right before the fourth quarter, because there are a lot of companies out there where well more than half their business, sometimes 70, 80% of their business is just for Christmas alone. So it's just something to think about when you're, and you kind of notice these trends. So it's not a bad thing for a company to have such a big cash outflow, because they're stocking up for Christmas. And as long as they sell it, it's fine. Yeah. obviously not all companies are seasonal. Like AT&T is not seasonal, but a clothing store is probably seasonal. Certain products are going to be, you need gasoline all year round. It's not like Christmas. You may need a little more gasoline if you happen to travel more, but it's generally, yeah. McDonald's, no Best Buy, probably. Okay, so let's, our inventory went up 10 million, so we minus 10 million from inventory. We did that. Now, accounts payable, I was going to guess dividend payout. No, I mean, this is the kind of things that make you got to start thinking about these things. Yeah, it's possible dividend payout if we pay dividends, or if certain companies, like in the U.S., companies usually pay quarterly dividends, but non-U.S. companies, like companies in the UK, I see a lot of them paying dividends twice a year, or some even paying once a year. So if it's a company that pays annual dividends, if it's the quarter they're paying a dividend, sure, that makes sense. So accounts payable, we add 20 million to CFO. Does anybody know why? Because accounts payable is 30 million. So why are we adding 20 million? Shouldn't we be adding 30 million? Wouldn't that make more sense? This is the first time in this stream I feel like I'm getting like people watching. For like the first 2 hours, it was like I feel like hardly anybody was watching. But maybe it is the fonts. But what's the reason why did I increase accounts payable 20 million? But it says 30 million. Shouldn't I increase it 30 million? Stock-based compensation? No, I mean stock-based compensation is not part of accounts payable. We actually didn't even have stock-based compensation at all in this. We probably should if I do another year or something. I know Richie or Yacero is going to get this. Why? I mean, think about the reason. What is the purpose of statement of cash flows? No, don't say sorry. Any guess at this point? You got to start thinking of this stuff. It's just good to think about. The purpose of statement of cash flows is looking at what the company did for the year. So in this case, it's for 2023, and we're converting the net income to cash. Now, it has nothing to do with GAAP. We're following GAAP right now because we're using accounts payable, accounts receivable. Because there was already 10 million of accounts payable at the end of 2022. We still had that sitting on the balance sheet. And in 2022, we recorded 10 million of accounts payable because there was nothing at the end of 2021. We added 10 million in 2022, but in 2023 we added 20 million of accounts payable. I wrote it was 20 million. Oh no, it was 30 million. Sorry. So we did, because last year, so at the end of 2022, we had 10 million of accounts payable. So going into 2023, there was already 10 million in balance sheet. Then we paid 10 million of accounts payable. At the very beginning of the year, we paid 10 million and then we added 30 million of accounts payable. So for 2023, it was 30 million of accounts payable minus the 10 million we paid. Because when you pay accounts payable, it decreases cash. So it was 30 minus 10 equals 20. If we didn't buy anything on account, the $30 million of product, if we didn't use accounts payable, right, then we would have just had this $10 million negative. Then it would just been a negative 10 million here. But we bought 30 million on credit. So for the 2023 accounting year, we had a cash inflow of 20 million. Does that make sense? I feel like I feel like I'm making things confusing, but so yeah, so that's what you got to do when you look at changes in working capital, accounts payable. You got to look at it from last year to this year. So accounts receivables, we extended 10 million of credit, because last year I guess at the end of 2022, there was 10 million of accounts receivables on the balance sheet. And now there's 20 million. So accounts receivables went up $10 million for 2023. When accounts receivables goes up, cash goes down. Because you might have, I remember when I was FIFO and FIFO is? Actually, you're not even allowed to use LIFO, I think, in the US. You have to use FIFO. But you could use LIFO in other countries. And if you do use, use LIFO, FIFO, you have to show it in the other, like if you use LIFO inventory accounting, you have to have a FIFO reserve to show the difference. So last in, first out. First in, first out. Does anybody know what this is? LIFO and FIFO? This might be confusing if I try to explain LIFO and FIFO. I did videos on this. Like if you bought in, like say you buy engines for cars. And then you kind of like refurbish the engines or whatever, and you sell them. So let's say in January, say you buy it's for recording the cost of inventory, and it's also for recording inventory in your balance sheet. So if say it's so fucking small. Say you buy one engine a month, right? You're a small business, you buy one engine a month, and you usually sell one engine a month. You buy it and you kind of refurbish it and you make it really powerful. I use LIFO for some stock positions in order to get long-term. There you go. So your inventory and your balance sheet, generally things go up in price, generally. So the inventory on your balance sheet, say you have 4 engines you bought. You bought one in January, one in February, one in March, one in April. So let's just pretend you didn't sell any for the first 4 months. So your inventory balance is $46,000. That's on your balance sheet. And if you use FIFO, if you use FIFO, which I think is, I think you have to use it in the United States, but that means first in, first out. So if you sell that engine, it doesn't matter how much you sell it for. You might sell it for $15,000, $20,000, $30,000. Doesn't matter how much you sell it for, but if you use FIFO and you sell it, then your cost of revenue is $10,000. Let's just pretend you sell every engine for 20. So your gross profit is $10,000 because you always sell it for $20,000 an engine, and your cost of revenue is $10,000 because you're using FIFO, first in, first out. But if you use LIFO, LIFO is last in, first out. So you have to use the latest inventory you purchased. So your gross profit would be $7,000 under LIFO. And the way I think about it, when I think of LIFO, I use the L. LIFO usually means lower profit, lower taxes, and lower net income. Because let's just say your tax rate is 20%. So it's $2,000 in taxes on the FIFO, $1,400 on the LIFO. So I always thought of like, but that also means if you use LIFO, do you guys know how much your inventory would be? Like if you sold one engine, say in April, this was your balance sheet. That's your balance sheet in April. And then you sold one engine. So your inventory under FIFO would be $36,000. But your inventory under FIFO would be $33,000. Yeah, Keith, exactly. So if you use LIFO, you can lower your taxes and it lowers your inventory. But do you know what does LIFO inflate? So if you use LIFO, what are you, because obviously everything can't be lower, right? Do you know what goes up? Well, yeah, cost of goods sold is you inflate your cost of goods sold. So I always thought of like Ford Motor Company. Like their inventory is like like $1,000, because they're still using inventory from the early 1900s on the balance sheet. Yeah, it does shift. Everything is just kind of like manipulating numbers. That's pretty much what it is. But a lot of people, if you're a CEO, you want to manipulate it while you're there, so you get a higher bonus. Because who cares in 20 years? You won't even be there. You might not even be alive. So you just want to, kind of like the president, you just want the economy to be really, really strong while you're in the presidency. You don't give a shit in 5 years when you're gone, or 4 years. So you just want to make things really good. You can switch it. Some people do average inventory costing. If you're not a manufacturing company, it doesn't even matter. Like if you're a service company, like if you're like a massage company, you just provide a service. There's really no inventory, but you could switch it. But I'll explain one other thing. Okay, so accounts receivable is minus 10,000. Okay, so now we want to acquire another company. And a lot of this stuff, there's so many nuances to it. But I think if you just understand on a real high level how it works, when you look at the balance sheet, it'll make sense. Okay, let's just say you want to acquire a company for $5 million. Say it's sandals. Your slippers beyond retail. Their sandals beyond retail. But no one's ever figured out why I picked this name, Slippers Beyond Retail. Like, what is it? How does it like tie to me? But okay. Okay. So you want to acquire this company $5 million, right? So when you acquire another company, you take all their assets, all their liabilities. So the company you acquired had $4 million in assets. It was all inventory, $4 million of inventory. See how these equal the reconciliation in net income? So it's reconciled right now, right? Let's make sure. Let's keep it reconciled. Okay, so we're gonna pay this company $5 million. So we're down $5 million. They give us $4 million of inventory. That's because whatever's on their balance sheet, we add to our balance sheet. So inventory, we add $4 million. And then they have $1 million of liabilities. So we take on their debt as well. what did I just minus $1 million. I have to add $1 million of debt. So we paid $5 million, but their net assets are $3 million. Net assets are assets minus liabilities. So why did we pay $5 million when the company is only worth $3 million? Does anybody know? And this is open-ended, like there's no real answer because it's not a real company. But why would anybody ever pay more than a company's worth? And usually companies, usually a company pays more than a company's worth, more often than not. It's very rare you pay less than a company's worth, less than a balance sheet. Well, it is goodwill. I mean, I know we have to add $2 million of goodwill, but I'm saying why? Why would they pay more than they're worth? Goodwill is just a plug. It's a meaningless asset. It's just a way to get the balance sheet to balance. It's when assets minus liabilities, when net assets are less than the acquisition price. It's called goodwill, the premium you pay when you acquire another company. I mean, there's a lot of reasons you would pay more. Maybe they have a good brand name, like Coca-Cola is worth a lot. That the name alone is worth a ton of money if you had access to that name. So a brand is a popular reason you would pay more. Maybe they have their technology. They have good technology you're acquiring. Maybe they have a good customer base. That's is going to result in lots of profits in the future. Yeah, I mean, you always hope to get more money when you acquire another company, but a lot of companies end up overpaying and then writing down the goodwill in the future. So a lot of companies overpay and it doesn't work out. Sometimes you overpay just to get rid of a competitor. Somebody is competing with you, so you just want to acquire them so you don't have that competition to deal with. So it could be for a number of reasons, but whatever it is, you have to record it as goodwill on your balance sheet so the balance sheet balances. Obviously, when you're buying something, you want to pay as little as possible. And when you're selling something, you want to sell for as much as possible. Do you know what it's called? It's not common. Do you know what it's called when a company pays less than the company's worth? So like assets, 100, liabilities, 80. So net assets, 20, but the acquisition is for 15. It happens, but maybe Slippy's is using their service and is motivated to bring the service on board. Yeah, I mean, does anybody know what it's called when a company pays less? I guess it's not a common term. I don't know. It's just called distressed sale. And it's usually a public company usually wouldn't get, if it was a publicly traded company, then I don't think it can be, I don't think you could acquire it for less than it's worth. Because it's generally trading at, well, I guess that's not true. Usually a public company, you can't, you already know the price of it. It's whatever the price is in the open market. But for private companies, you can pay less. Badwill. Yeah, I mean, I've always heard distressed sale, but I guess you can call it a discount. So in that case, you would have negative goodwill. But if you did, if assets were 100, liabilities were 40, net assets were 60, the acquisition was for 80, goodwill of 20, and if like in a few years from now, the company you acquired wasn't performing as well as you thought it would. You thought you would get all these new customers and you thought their products would sell a lot, and it turns out the company wasn't that good, and you should not have acquired them. So what you do is you write down the goodwill, you decrease it on your balance sheet. So maybe you change that 20 to a 0 and then pass through an impairment on your balance sheet, on your income statement, an asset impairment. But the thing is, once you impair a goodwill, you can't bring it back. Like if the company you wrote down, if business starts coming back and you're doing really well with that investment, you can't increase the goodwill once it goes down. Do you know what it's called? There's something when you decrease your goodwill, what's the term? Because goodwill, I know someone knows, is an intangible asset. Goodwill is intangible. And so like another intangible asset is a patent. And the way you decrease the value of a patent is that it amortizes. Over time, the patent amortizes. A tangible asset is a building. And a building, it doesn't amortize, it depreciates. But goodwill does not amortize. All intangible assets amortize, except goodwill. How do you decrease the value of goodwill? What's it called? What's the term? I know somebody knows this term. It starts with an I. It's called the goodwill. It's a goodwill something. And you test every year. You test for goodwill. Goodwill I. Irradiation. Oh, it's right here. Goodwill impairment. Yeah, every year you test for goodwill impairment. So goodwill doesn't amortize each year like it used to. And then like the 1990s, it used to amortize. And then in like 2005, they changed the rule where you don't amortize it each year. You just test it annually for impairment. So, but every tangible asset depreciates except what tangible asset never depreciates? I'll just say what fixed asset never depreciates? Because cash is a tangible asset that doesn't depreciate. But what fixed asset never depreciates? Land never depreciates. So land never depreciates, is the only fixed asset that doesn't depreciate, and goodwill is the only intangible asset that doesn't amortize. But like I said, just understanding these kind of concepts, it does help a little bit when looking at the financials. Okay, so we did the acquisition. We plugged in the goodwill for so now let's do our cash reconciliation. And you could always look on a statement of cash flows how cash matches the balance sheet. So the cash at the end of the year, I appreciate that. Thanks for saying that. Oh boy, we're off 5 million. Okay, the cash at the end of the year is 75 million. So cash on January 1st was 65,424. So you see 65,424 at the end of 2022. At the end of 2023, it's 75,752. So cash went up 10 million. So that means when you add cash flow from operations, cash flow from investing, and cash flow from financing, you should get the change in cash. But it's not reconciling. I'm off 5 million. Do you know why? The acquisition. Nice. I hope this works, but like cash 17.3 billion. This is Microsoft. And then it went up to 34.7 billion. 17 to 34. So this is their statement of cash flows, right? We need to look at a 6-month period because that's how their balance sheet is every 6 months. So the cash at the beginning of the accounting period was 34.7 billion. 34.7 billion. 34.7 billion. That's their cash on June 30th, 2023, at that point in time. Now, over the next 6 months, they used up 17.4 billion of cash. See the net cash change? 17.4 billion. The way you calculate that, it's operating cash flow plus financing cash flow minus investing cash flow. Well, you could do the math if you want, but when you sum up the 3 sections on the statement of cash flows, you get your change in cash for the period, for that 6-month period. So they started with 34. They lost 17 billion of cash. At the end of the accounting period, it's 17,305. So it doesn't always work out this way because some companies you could figure it out, but some companies with like if they use a lot of foreign currency transactions, sometimes it's off, but I figured Microsoft would do a good job. So that's how kind of like you can track. This is how you track cash. And if you want to know why they burned through 17 billion of cash, I know why. You might know, probably because of, actually, it's not. I thought it was because of stock buybacks. But that was only 8 billion. It's mainly because of acquisitions. They spent 80 billion in 20 billion in PP&E, 66 billion acquisitions. What was their big acquisition, Microsoft? It was what's that? What's that company? That big acquisition? Activision Blizzard. Yeah, Activision Blizzard. Goodwill. Look how much goodwill they have. 118 billion. Microsoft. I'll show you why Apple is a beast. They're one of the few companies, they don't have goodwill. Well, let's see. Maybe it's part of non-current assets. They generally don't have goodwill because they don't need to acquire anybody. They do acquire companies. I'm not saying they don't acquire. They acquire a lot of companies, but they never pay more than a company's worth because they're the kings. Their technology is so superior. They don't need anybody's help. but Microsoft is bigger now. But if you can grow a company without goodwill, you are doing an amazing job. It's hard to grow a company without acquiring other companies and overspending. Okay, so in the investing section, we have to put, wait, how much was the acquisition for? Oh, 5 million. So we spent 5 million on acquisitions. That's a real cash outflow. It is possible we acquired a company with stock. And if that was the case, obviously Apple, Microsoft didn't use stock. Maybe some stock, but mostly it was cash. Because we saw the statement of cash flows. If they acquired Activision Blizzard with stock, we wouldn't see it on the statement of cash flows. Because $75 billion, the acquisition will accelerate growth. And I don't see. So they paid $66 billion of cash to acquire Activision Blizzard, but the other $9 billion was stock. Because it was 75 billion, so 66 in cash, 9 in stock, which I was looking for here, but I don't see it. They say here it's an all cash deal. It usually dilutes shareholders when they pay in stock. It was an all cash deal, but it does say total purchase price 75 billion. Okay. Oh, it does say right here 75 billion, primarily of cash. So it wasn't all cash. It's mostly cash, because we saw on the statement of cash flows that it was 66. It would say 75. I mean, they pretty much say an all cash deal because it was probably like a majority of it was cash, so it's just easier to say all cash. The financial results, and you could see of the 75 billion. What the hell? Okay, of the 75 billion, 50 billion was goodwill. So only 25 billion was real assets. The other was air. they got $13 billion of cash that was sitting in Activision Blizzard's bank account, $22 billion of intangible assets, which is also kind of not, it's not tangible. It's not nothing they can sell. They took on some of their debt. Okay, I think this is why they say all cash, because so that was on the statement of cash flow, 66,215. But they actually got 75,406. And I think if you strip out all these negatives, it would be close to that. Not quite. 66,215. Is Warcraft, how do you estimate that? It seems crazy, right? How you overpay, but it's just how it is. Okay. Okay, so we'll reconcile. The cash is reconciled. So to close out 2023, we move the 14 million to retain earnings. And 2024 kind of starts fresh. So what do you think I should do for 2024? Oh yeah, I wanted to mention one thing. Yeah, so for 2024, what do you think I should do? Should I employees acquisition company and how the cost and profits add to next year's. Oh, so usually when you do an acquisition, you actually it's usually not this straightforward. It's you usually have to revalue the fixed assets. I forgot what you have to. Yeah, because usually the assets aren't carried on the balance sheet at their appropriate price, so you usually have to revalue them. I can't think clearly on that, but also it's very rare. Like in my spreadsheet, I had the taxes. They were paying whatever they had in taxes. They would pay. They would subtract the cash would be subtracted the amount of taxes. Where it's very rare that the taxes on the income statement is what the taxes the company would actually pay. Like in the fourth quarter of 2023, they had 4.6 billion of taxes. Let's do the last two quarters of 2023. They paid 9.6 billion of taxes. But if you look on the statement of cash flows, they didn't pay that much in taxes. Well, they don't list it. You don't really know what they. The way they adjust it is there's something called deferred income taxes, because the taxes on the income statement are not the taxes the company pays, because taxes are calculated differently for GAAP versus the IRS. And the reason they're calculated differently is because of depreciation. GAAP uses a different type of depreciation method as the IRS. So they do even out. So if it says 3.8 billion taxes, they probably paid like 3.7 million in taxes. That $100,000 would be carried on a balance sheet as deferred tax asset, as a deferred tax asset or deferred tax liability, depending on which direction, whether you paid more or less. And then the following quarter, that would be adjusted. It's a little confusing, but I just pay the taxes that we on the income statement, but that's rarely the case. Taxes are a bit confusing, and I'm not sure if many people are familiar with. I get really confused over taxes, so I'd have a hard time calculating or understanding it. But just so you know, like, because like they have deferred income taxes on their balance sheet in the liability section. So this is money they they need to pay to the IRS. Probably like next, later on in like next quarter or next year. Or if they had deferred income taxes, if it was up here in the asset section, it would be a tax credit. So maybe they underpay taxes according to GAAP. So that's why they have a deferred income taxes in the liability section. If they overpaid it, I guess it would be an asset. But like it's I mean, I understand it on a higher level, but I wouldn't be able to calculate it. Okay, well, it was a slow stream. It took a while to get, at some points there was only 3 people on the stream, so it built up. Maybe I'll do it again with better graphics. I think that was the problem. It was just hard to see, and I didn't realize that. But okay, well, thanks for joining or watching. I'll see you next week.